Okay, welcome to my Mortgage Mondays. I have Alejandro Juarez back with me. I feel like he was a really huge hit for us last week.
Do the best that I can.
So today we're going to actually dive into, I think, a really hot topic going on just nationwide. Everybody is wondering, do we have a recession coming our way? And how much is this tied to what has been going on in the housing market? To sort of kick things off, Alejandro, do you have any news or updates that kind of happened last week or over the weekend before we go into some prompted questions that we have?
Yeah, I would say that a lot of what happens with interest rates is tied into, I always think about it like it's like gossip, right? When people are
That's a good
gossiping
way to
about
put
things that
it.
are like about to happen, then people that are receiving the gossip start making decisions based off of what they're hearing coming down the grapevine, right? And
Mhm.
so that's a lot of what happens right now with interest rates is that the Federal Reserve has meetings set up throughout the year. They have several meetings, and during those meetings, they make decisions about whether they're going to increase interest rates. We, at home, imagine that that means that those interest rates are being changed across the board and that they have a direct translation to mortgages. And we talked about that last week, that it doesn't exactly work that way. But in
Mhm.
the environment that we're in, where rates have been going up increasingly and quickly, there's no doubt that there's going to be some kind of impact on the actual news when it is released on Wednesday. So essentially, what has been happening the past couple of weeks are that people are speculating that this Wednesday, the Fed is going to increase rates again.
Mhm.
Why? Well, people that are a part of like the Fed board have made comments that would make it seem like that is what's, going to come down the pipeline. So you've already seen a negative downturn in interest rates when the market opened this morning. You could see that there was an impact from even that news, and rates
Okay.
are already getting worse because that's essentially the gossip tree
Okay.
reacting to the news that's coming down the pipeline. And they're saying, well, they're going to increase rates on Wednesday. We should start preparing for that. And you know what I mean? So that's essentially what's happening over the weekend. Tons of gossip, tons of speculation, and everyone looking forward to Wednesday to find out what actually happens. But it would appear that the Fed is going to increase rates yet again on Wednesday.
Okay. Perfect. Yeah, that was going to be our first section here. And Alejandro did a
Mhm.
great job of opening us up. There are rumors buzzing about a recession, and everybody's waiting for what is going to exactly happen on Wednesday. I have a couple of snippets here of what some of those rumors are, what some of that gossip is that Alejandro is referring to. Let me hide that banner so we can read it. So in the Washington Post, they say that the Federal Reserve meets next week and officials are expected to raise the benchmark rate again. In March, the central bank took its first steps towards bringing down the inflation rate by raising federal funds rate by a quarter percentage point. And the first rate increases since 2018. In the 6 weeks following that increase, the 30-year fixed rate average has risen by nearly a percentage point from 4.16 to 5.1. Then I have, excuse me. Then I have that besides raising the federal funds rate, the Fed is also expected to announce its plans for reducing its balance sheet, and how quickly it sheds mortgage-backed securities from its portfolio may also affect how rapidly mortgage rates will rise. Do you by chance have some tips or feedback for us, Alejandro, that helps us normal people understand what that part would mean of Wednesday's meeting?
Yeah, actually, I was thinking about it as you were discussing the first part, and I was thinking about how complex all of this stuff is because I think most, the layman, and including myself, I mean, I've been doing this for a long time, and even when I read the reports about what's coming on, I'm like, what in the world are they talking about? And it takes some time to analyze and put the pieces together and then say, okay, I get it now. But to describe it in a really simplistic way to everyone is by saying that a mortgage note is like any commodity. It's like an iPhone. It's like a computer. It's a pair of glasses. It's a commodity. You purchase it and you sell it.
Okay.
And what's a perfect example is like a car, right? You purchase a car and then down the road, you're going to sell the car. You're hoping that someone is willing to buy that car at a reasonable value, right? Like that sort of thing.
Nice. Okay.
And so with mortgages, what happens is that they are traded and sold on something that's referred to as a secondary market. This is basically investors and also the Federal Reserve purchasing mortgages that have followed all of the rules that Fannie and Freddie Mac have, put forth. This is why when you go through underwriting, there are all of these conditions, right? And people are super strict about your employment, your work history, your address history, because what the investors are trying to do is ensure that these mortgages follow all of the rules that Fannie and Freddie Mac had set forth, because after the loan closes, their expectation is that they're going to sell these loans on the secondary market. If they're not following the rules, then they can't sell the loans on the secondary market, and they have to hold the loan, which is what every investor does not want to do, because then they don't have liquidity and they can't go and sell and buy and trade other things, right? And so what that statement is referring to is that the Federal Reserve has been hinting at the fact that they are going to stop purchasing as many of the mortgage-backed securities mortgages, and that's very scary, because essentially what that means is that now there are going to be all of these other mortgages out there that need to be purchased and traded and sold that won't have the backing as much as we've had in the past several years from the Federal Reserve. And that will likely cause interest rates to increase because risk profile goes up, that sort of thing. And so what was going on was the opposite of this during COVID. During COVID, the government came through at one point, and I forget all of the specific details, but they essentially came through and said that during that time of volatility that they were going to increase the amount of purchases for mortgage-backed securities, which made it really easy for mortgage companies to close these loans and sell them, because the government was there just eating them all up and buying them. But now they're reducing their purchases, which tightens up investors, because now they're closing these loans that they're going to have less demand for, because there was huge demand from the government purchasing them, and now not so much. Does that make sense? I hope.
It does. It does make very good sense. So during COVID, when we really needed to have some stimulus, pumped into our economy, the government was providing support by saying, we'll take whatever you guys are putting out there. But now they're going to really dial that back. And so the investors are going to be raising their interest rates, because they will most likely be holding on to more loans.
Or it's not necessarily that they'll be holding on to more, but that they will have a harder time making the right amount of profit from these loans, because they often have to sell them to a willing buyer. And so that buyer may say, well, I'm not going to buy it for that much, but I'll buy it for this much. And then that person that closed that loan, or that company that closed that loan, loses a margin off of that mortgage, because they're not getting full price from it. It's just like selling or buying an iPhone, using it, and then trying to resell it for full price. And now the person that's buying it from you is like, I don't really want to buy it from that much. You still sell it and you get it off of your books, but you lose money because you didn't sell it for as much as you were hoping for, because now the supply would, hypothetically, the supply would be greater than the demand, because now the Federal Reserve is not buying as many, so that there are less investors that are purchasing these loans.
That is really interesting, Alejandro, because that's actually going to have me jump ahead to what was going to be, I think, our last question. But I feel like this really ties into people's concerns about us being in this housing bubble. So let me put that question up here, that there is a big debate on whether we are in a housing bubble, and if Austin is one of the U.S. cities considered to be overvalued. How does the situation compare to 2008's housing crisis or housing crash? So with you just describing that the government was sort of taking on these loans, and that was, almost it was very easy for the investors to offload the loans that they were selling. Do you think that would be tied into everybody's concerns of like, well, that's causing a housing bubble or housing crash? It was too easy to, have them offloaded. Could you?
No, I don't think so, because I think the most important thing to take away from that, or something that's very important to take away from that conversation, is that these are things that are happening on the back end of a purchase, right? most of the things, in fact, I would venture to say that 99% of the things that we just talked about are
Yeah.
things that most buyers and sellers and agents never have to think about or worry
Okay.
about or know, because it's not really impacting whether mortgage companies are going to offer the loans or
Okay.
close them.
Mhm.
But it is a back-end issue that in fact affects finance, right? It affects interest rates. It affects the ideal mortgage situation for a purchaser, but it
Mhm.
doesn't affect necessarily the real estate market that way. It is affecting the real estate market, in my opinion, now, but not in the same way that things were going on in 2008 and 2009.
Okay, so yeah, I have done several videos saying that this is nowhere like the 2008 housing crash, because that had everything to do with those loans being written at that time just being a total house of cards.
Mm-hmm.
And so when people are so fearful of the home prices taking off, and so certainly this is going to pop, I try to make it very clear in the information and the data that I provide that home prices are taking off because of the historically low interest rates that we had the last 2 years, of course, but also because we have this record low inventory problem. And so it's extremely low supply and extremely high demand. And when you put those two things together, we end up having the commodity priced out way too high. But I'm sure that people would love to hear from a lender a little bit more about just how poor those loans were in 2008.
Yeah.
And get some more perspective on the financial side, if you could.
Yeah, so there, I wasn't working as a lender in 2008, but I've been around for long enough that I've talked to so many different people that have been in the business for 30 years, and will tell me all about the way things were there. And I always joke around with them and tell them, man, that sounds like the wild, wild west of mortgage, And they were like, it really was. I mean, I've heard stories of one of my really close friends that was a lender during that time, that you could pre-approve somebody on Tuesday and be closed on the house on Thursday. Like,
Wow.
it was that ridiculous. They had terms that were called, I want to say they were called ninja loans. It was something like no income, no assets or something like that. I can't remember the actual acronym, but it was like, if a person had a pulse, they were going to get a house, right? And they were just kind of Oprah-ing the situation, like, you get a house and you get a house and you get a house. And so what ends up happening is that I think we can all be fair and say that there are some people out there, unfortunately, that probably should not bear the responsibility of a mortgage because they have credit issues that they have not been willing to or able to take care of, right? And so when you're giving them mortgages and they now have a $3,000 a month responsibility that they had to show no proof of ability to repay, over time, those people begin to default, right? And they're in mortgages that are adjustable rate mortgages. So as the payments were fluctuating, people found it difficult to actually survive in those mortgages. Then there were, employment issues as well. When I think back on 2008, 2009, I always try to tell people, like, to not call it a housing crash, because it was really more a mortgage crash, right? It wasn't the actual real estate market that failed. It was the financial instruments that were being used to purchase these homes that failed. That's why the real estate market fell apart, because then all of a sudden you had a record number of people foreclosing and losing their homes. Then that causes the market to lose value because you have an abundance of foreclosures, but that doesn't have anything to do with the real estate market in and of itself. It's just it's a consequence of lending money to just about anyone that lives, breathes, talks, walks, and runs. That was not a recipe for long-term success, which is why the federal government took over conservatorship of the entities that make the rules for mortgage. Fannie Mae and Freddie Mac are under conservatorship from the US government because they had to get control of that and say, okay, no more of these crazy freaking loans.
No more ninja loans.
No more ninja loans, none more of this BS. These are the rules now. We need 2-year history. We need 2-year income. We need to be able, if they're using commission income, we need this. This is why people now, pull their hair out when we're going through pre-approvals, because the rules are super strict, but they are intended to protect everyone, because what we need are buyers that can handle and bear the responsibility and have a much lower rate and chance of going into foreclosure and losing their homes. As long as that continues to be the case, the market will stay stable. People will continue to be able to purchase without things falling apart. But that doesn't mean that rates aren't going to go up and that there aren't going to be, inflated mortgages because of inflation and all of these other things. The last thing I'll mention is that all we have to do as lenders now is ensure that the clients that we're pre-approving can handle and bear the responsibility of the current mortgage market. That means that they're going to have higher interest rates. They're going to have higher interest rates than they had last year. That's just a fact. I can sugarcoat it and glaze it up and polish it as much as people want, but rates are higher now than they were last year. There is no doubt about that. That is a fact.
Well, and so with that, let's talk about the next part, which is the Fed is hoping that with raising the interest rates, it's going to cool off the housing market, which is believed to be only one of the leading causes for inflation, because there's also other reasons as well. So are we seeing this take effect already? So as a real estate agent on my end, I am certainly noticing that there's a lot of price improvements. That's what we call them, as price improvements. But what we're really doing is reducing the prices, because we were able to sort of price the top of all ranges and still continue to have multiple offers from there. So we are having price reductions. We are having to now tell sellers maybe to not have 10 plus offer expectations, but now more of like a 2 to 3 multiple offers. Very key to price your home appropriately. And I really do feel that for Austin in particular, the release of the property taxes also brought some new properties to the market, because many investors suddenly don't have their numbers working for them anymore, and they're looking to offload some properties.
Right.
Are you seeing, I was looking at some articles that were sharing that we are having less mortgage applications. Are you experiencing that as well?
Yeah, definitely. Mortgage applications slowed down a tiny little bit. I think earlier this year they were getting off into a really good place. But these are things that you expect to see anytime that we're getting close to the Fed making an announcement. And especially, I think the biggest impact, at least here locally, was this announcement by Travis Cad for all of the property tax changes. I think that sent everyone for a complete, loop.
Yes.
But yeah, we're definitely seeing a pullback. We're seeing some of the similar things that you're seeing as far as contracts coming in where clients have gone under contract for list price, which is which seemed ridiculous for the past 2 years. It's like, wait, I'm sorry. Did you say you got it at list? I'm sorry. So we got some contracts this morning. It looks like they came in at list. We had one contract, I think about a week ago, that came in just under list. And I thought, what?
Ooh, yes.
Yeah, I was like, wait, what's going on here? Yeah. And so you're starting to see it have an impact, because what's happening is that people that are scared right now or that are waiting for the right time are pulling back. And then the other people that are brave and see an opportunity to secure property now are taking advantage, and they're the lone ranger standing. So they get the house because now everybody else is pulling back. And that's something that I think is really important for people to start thinking about, because although you may be afraid or scared, we all know what the true heat check of Austin is. If rates were still the same as they were last year in the mid 3s, high 2s, or whatever the case was during the COVID pandemic, we would not be seeing this right now. Austin would still be ridiculously impossible to purchase in, and there are people that want to live here. And if your priority is to secure a property in Austin, right, this is a great opportunity to do that, because other people are not going to be willing to jump on that. And you can secure the property, wait for the right time, refinance, and keep your house and be in that perfect mortgage down the road. But right now is a chance. It is a chance to purchase a house that other people aren't willing to move on.
Because as the year continues on, the supply shortage is still here to stay. So we're still going to see an appreciation in prices. We're expected to do another 14 to 20% price appreciation just this year. And we really need, as homeowners in Austin, we need that to stop, because we are having this property tax issue of my home needs to not be worth so much so that I don't owe so much during tax season. So there's a lot of talk about affordability, certainly. I have a really interesting graphic here that I can show. This is not Austin in particular. This is nationwide. I did show this on a previous video that I had of just how housing affordability is going. So those orange bars are going to be post 2008. So the higher the bar, the more affordable the house was. So obviously post 2008, we had a lot of distressed properties out there. So the homes were, just super affordable. Then we go into more 2015, 16, 17. We're still looking great for housing affordability. And then unfortunately here today, we're at a 135 level, and we are starting to drop down to what it was like in the 90s. So while we are not as in dire of a situation as we were in the 90s for housing affordability, we certainly are trending down that way. And I have a really interesting fact about that. The median income for Austin at this time is around 80,000. And the home that you want to purchase with that income, correct me if I'm wrong, is somewhere in the mid 300s. And that is just not available here in Austin anymore. Now, we do have really great income increases coming to Austin, but a lot of that has to do with the very special jobs of Facebook and Google. And so if you're working with one of them, then of course you're seeing this incredible income increase. But if you just have a normal job with a local business, you're probably not seeing a 10% increase in your income. You're seeing more of the standard 3% increase. So there's a balance here of Austin is perhaps could be considered recession proof. We did not fare so badly during 2008 as well.
Right.
We do have incredible businesses coming to our town, and that will help give us a barrier and a soft landing if we do have this recession coming. However, it is important that on the other end of things, we start resolving this low supply issue and affordability issue that is coming our way. And so the rising interest rates, just like what Alejandro was just describing, is a really key part to helping make sure that more people have a chance of getting into this battlefield. So.
Yeah, I really do believe that. I feel like for those that feel like Austin is in some sort of a real estate market bubble, aren't looking at the bigger picture and realizing, how small Austin is and how much more it still has to grow.
Yeah.
Obviously, there are inventory issues and construction issues like we talked about before, but I think in the next 20, 30 years, Austin is going to look completely unrecognizable to what it looks like now. You look at Houston, you look at Dallas and San Antonio, they're massive, massive cities in comparison. Our population is dense for sure, and it is without a doubt the most popular city in Austin. But part of why we saw a lot of the issues with inventory and competition is because it is still relatively small. And as it continues to grow, the city will grow and the market will stabilize and be in a good place. It's got a healthy future for a very, very, very long time, I feel like.
And then just to kind of finish off, I want to show what last week's numbers gave us, which was months of inventory basically doubled for all counties. So now everybody realize that that's just a quarter of a month inventory up to 3/4 of a month of inventory.
I'll take it.
I know, exactly. Yes. A seller's market is 0 to 6 months of inventory. So we still have a long way to go before we would be out of home price appreciation. But it's doubled since last year, and that is exciting. And you should definitely take up what Alejandro is saying, and myself as well, that now is a wonderful time to get out there and scoop up a property before the interest rates keep climbing and before the home price appreciation just continues on, because that will continue on for this year. Thank you so much, Alejandro, for coming back on my show again this week. It was just always really a huge pleasure to have you on. You have such great information to share. And I want to be sure to have you back on. Alejandro Juarez is with Loan People. And can you go ahead and let them know about your website and information again?
If you're interested in getting some more information about us and also just getting educated, you can go to the JuarezGroup.com. That's JUAREZ. The JuarezGroup.com. There's an education tab there where you can watch some videos where I talk about different mortgage related topics. So feel free to check those out.
All right. Thank you so much, Alejandro. We'll see you guys next week.
Bye.